Good afternoon. Thanks for joining us. It's Wednesday, September 30th, 2015, and this is Ask the Experts. I'm Chris Grams. I'm with CME Group, and I'm joined today by two grain and agricultural experts who are going to be sharing their insight on today's USDA reports. At the end of the table, we have Virginia McGathey. She's president of McGathey Commodities, which she founded in 1987. She's a broker on the CBOT trading floor, where she's been a member since 1983. She regularly provides expert market commentary on commodity and financial markets. Virginia, welcome back.
Good to be back.
To her right, immediately to my left, Dr. Bill Tierney is chief economist of AgResource Company, a domestic and international agricultural advisory. He's an esteemed economist with more than 30 years of experience researching, modeling, and forecasting commodity prices for wheat, feed grains, oilseeds, and biofuels. Bill, welcome back as well. Good to have you. Today we had the quarterly grain stocks reports among some other smaller reports from the USDA. I guess we'll jump right into it. Virginia, how did the market react to today's reports from the USDA?
We really had a lot of volatility, and we'll start with the soybeans. That as soon as the number came out, it was definitely friendly to soybeans, and I think the expectation was going to be a little bit the other way. And the market rallied so hard, up over $9. I mean, there was a 17-cent range within like the first minute. So there was a lot of, maybe short covering, panic buying, and then the market, sold off, and then it never really was able to get back above $9 for the rest of the day. So that was kind of interesting. Also with wheat, wheat's number was. Corn was a little bit more neutral, but wheat's number was also a little bit friendly. That was a surprise somewhat as well. That had about a 15-cent range, again, within that first minute. And it really just kind of lets you know the volatility of the market right now. I think that coming right before the report, in wheat especially, there was a lot of selling, right before the report, and then as soon as the report came out, all the short covering happened and really worked it right up. And as a matter of fact, I think we closed close to the highs for today on wheat, which has been a surprise all along. The other thing is that even though that the corn report was relatively neutral to just minuscule friendly, it just. It was definitely buy the rumor, sell the fact, and that was they got that sinking feeling in corn, and the market dropped about a dime, I think, right after the report, and then it started to build back up again, but it was still sellers were ruling the day in corn then after that.
Bill, before I turn to you for your thoughts on today's report, I just would remind our viewers that if they have any questions for Virginia or Bill, that they can submit those online. Please submit those questions, and we'll get those questions answered. Bill, your thoughts on today, a little bit different take on the numbers. Was there anything that really kind of stuck out to you from today's reports?
Well, from an analyst standpoint who looks at nothing but numbers rather than price reaction, it was almost unprecedented that the USDA lowered their wheat production estimate. The other small report that you failed to mention was the small grains report. It is almost always the final estimate of this year's wheat crop. There could be slight changes when we get out to the annual crop report, which is released around January 10th or 12th, but in all likelihood, this is the final number. So they cut the size of the crop by 84 million bushels. I went all the way back to 1950 to try to find a time when there was that large of a reduction in the size of the crop from the October estimate or the small grains report and the previous estimate. And there was only one other year that we saw a reduction between the October report and the August report that was on a percentage basis larger than this. So this is almost unprecedented. And what was really surprising is how they did it. They cut planted area by about, I think, 1.4 million acres. I don't have the exact numbers. Let me see if I can find the exact numbers. I think it was about 1.4 million acres that they cut. 1.435 million acres, and yield was reduced by half a bushel. Now, you can always change yield in this report, but to cut planted area, not harvested, but planted, they had to get some new information. And in all likelihood, the only thing I can think of is it was information that's in the Farm Service Administration data that NASS takes a look at. Every year, farmers around this time of year have to certify the acres that they planted or were prevented from planting. So I don't know what caused winter wheat acres to be planted last spring, or what caused other acreage to be prevented planting. But this is a somewhat unprecedented reduction. As a result, the wheat balance sheet tightens up, I would say, significantly. But I don't think it's enough to change the overall price dynamics of the market. Contrary to what most of our viewers are used to seeing, thinking that the market trades off of U.S. supply-demand reports, in the case of wheat, the market might trade off of it, but the cash market doesn't. The cash market right now is overwhelmingly driven by Black Sea fundamentals. And some of the strength that we've seen in the wheat market over the last couple of weeks has been due to dryness in southern Russia, the fact that the last gas tender by Egypt actually was up a few dollars from the previous one, and the fact that seasonally we tend to set our seasonal low sometime between late June and September. So we're overdue for a bottoming out in the wheat market, but that doesn't mean there's much upside potential, because we're also expecting to see record ending stocks, record exportable surplus remaining in major exporters. So even though for the U.S. wheat balance sheet this looks friendly, I think from the standpoint of global supply and demand, I don't see much changing. We could see some upside movement in the market, but we just simply globally have too much wheat chasing too little demand at this time.
Interesting. It's pretty good coverage on wheat there. Are there any other fundamentals, not necessarily relative to today's reports, but care to cover any of the fundamentals that are impacting corn or beans at the moment?
Here again, USDA sometimes changes their production estimates for soybeans in the stocks report for last year. And in fact, USDA lowered last year's crop, the crop year that we just completed, lowered their estimate of soybean production by roughly 42 million bushels. They did it, I think they cut yield by about 0.3 of a bushel, and I think they took about 400,000 acres off of planted and harvested area. If they hadn't have done that, stocks would have been significantly larger than the trade had expected. Again, while this might look friendly, that soybean stocks were smaller than expected going into next year, at this point in time, that's almost an irrelevance, because the market is overwhelmingly focused on the yield potential for this year's crop. There's some uncertainty about how many acres were actually planted. Again, we go back to this Farm Service Administration data. And increasingly, the market's becoming focused on how much of an increase we're going to see in South American soybean area. It's anticipated that both in Brazil and Argentina, possibly in Paraguay as well, we're going to see record area planted. And the second thing is that usually, not always, but usually El Nino is associated with above trend yields in South America for soybeans. So here again, while for the U.S. balance sheet, it should be friendly from the standpoint of global supply and demand. I think it's tomorrow morning people will say, well, that was tomorrow. Now let's focus on the fundamentals as they develop at hand. So I don't really think that we're going to see much I don't think analysts are going to be changing their S&Ds or their price expectations based on the stocks report that we saw today.
Right. Virginia, Bill brings up some good points about South American bean acres, and as we were talking before the panel, mid-September is really that time when those acres start to get planted in Brazil. Is that something that traders or hedgers are looking at right now?
Well, if they're not, they should be, because it looks like, I know that the number they were talking about was maybe like 4% more, but I think it could be up to 10% minimum more, and that would create a huge pressure on the prices, certainly for next year, and that would be, advising the farmers to kind of really take a look at it, because this could be the high here. I think that the fact that the market even rallied up over $9 and came off kind of shows a little bit of the inherent weakness. Looking at the strong dollar and the real, the devaluation of the real, that really makes that just so much more attractive. Everything that's happening, the economic downturn in China, really will keep them focusing on their purchases of soybeans from South America. And so it becomes more and more attractive there. And without any demand, we're going to be saddled with huge supplies here. And the only thing can happen is that it's going to put pressure on the market in a huge way. And so certainly for next year. And I don't know, unless we get some kind of a drought or something else, that it would have to have a malady of that sort to really turn the market around, and as far as that goes. But that's what we're definitely watching, and I think that that's really going to start to put some real pressure on the market going forward.
Speaking of weather and the potential for drought or other weather conditions, Bill, you mentioned El Nino. Have we seen the impacts of El Nino already? Are we still carefully watching for further impacts relative to El Nino, or has attention really shifted more to 2016 and La Nina and the potential knock-on effects of that?
I'll let Bill answer that one.
Well, apparently, some of the weather effects associated with an El Nino seem to be manifesting themselves in Southeast Asia and Australia. In the last couple of weeks, there's been increasing chatter, and the last 2 days at a palm oil conference, there's been a number of global vegetable oil analysts that think that we've seen the low of the market. There seems to be a consensus that El Nino will reduce palm oil production. The reason I'm talking about palm oil is that part of the value of soybeans comes from meal and oil. Palm oil, I believe, is the largest vegetable oil produced in the world today. It is certainly the largest traded vegetable oil. I think it represents about 65-70% of total veg oil that's traded internationally. So anything that tends to prop up vegetable oil prices will have a knock-on effect and tend to support soybean prices. However, soybeans are predominantly a meal oil seed. And so even if you see some stability in vegetable oil prices because of an El Nino reduction in palm oil, I don't think it's going to be enough to stop the other effects. And so I think meal prices and bean prices will work their way lower. The other El Nino effect that people are talking about, particularly over the last 2 weeks, is the Australian wheat crop looked to be in much better shape than people had anticipated, particularly the Australian wheat farmer had anticipated. And a number of analysts were bumping up their estimates. But now the weather has turned dry, and there's some concern that the crop will not finish as well as had been expected. So some analysts are lowering their estimate by 2 to 3 million metric tons. Here again, that's not enough to change, I think, the global surplus of wheat that we have. With regard to La Nina effects down the road, I've seen talk about it, but we haven't even figured out what the El Nino effects are still playing themselves out. Right. So while I'm sure weather forecasters are more than willing to go look, 8, 9, 12 months down the road, from a market standpoint, I don't know how to quantify that kind of weather risk. I'm still wrestling with the El Nino effects.
Virginia, has the market really factored that into current prices already, the El Nino effect?
Well, I think so. I mean, everyone's watching the weather. Certainly, all summer they were watching the weather, especially because we had such heavy rains early in June. And then we're watching. When you think about it, over the last like 6 or 7 years, if you didn't adopt the idea that the extreme is the norm, you might have got lost or washed away in the market because so many extreme things were happening. So this year, what was the extreme, what kind of extreme thing happened that we had so much rain in June? And that it really had a serious effect on the market, although our world supplies are still so huge that it didn't really make that much of a difference. But we start to go on the other side, even the fact that, in the western United States it was still pretty, hot and dry there, that it's so patchy all the way across the U.S. and I think that the production is still there on the crops. I think I was talking to a farmer in Illinois, and he said in some of his areas that he completely lost big sections of his acres, but on the sections that were good, he got like double the yield for it. So he almost didn't lose anything. So I think, looking at that and then really starting to watch what the yields come in, I think there's nothing else. There's nothing else that's here to really boost these prices. And so. I don't know. I mean, I'm trying to think what could be the next one. We have a locust or something. I mean, you never know.
So we're in pretty good position as it relates to the current corn and bean crop in North America, coming into harvest. Anything else that's on producers' minds at this point in the crop year? Any advice that you're giving to producers, whether it's from a market perspective or otherwise?
Well, seriously, one thing that I do know for sure, like I know that farmers were really looking to sell beans at $9. That's what I was telling Bill earlier. That if you didn't have that order in at $9, I don't believe it's going to get there again. That you had to have that chance. I don't believe that farmers are going to be able to sell $4 corn either. So, from that standpoint, the rally is in. This is about as good as you're going to get. Maybe you can try to hedge something off with some options. Clearly, the worry that South America is going to have this huge crop coming in, that's going to be something to watch going forward, that perhaps start looking at hedging November beans of 16, because, let's take a look at the livestock market and see what happened, right? That we limit down. I would have never expected to see leaving the October livestock at 125. It's unbelievable. So does that bode well for, more feed? I don't know. Not when it's, the market is crashing on that standpoint. And so where else will the demand come from?
Bill, what did we miss? Anything else we should be talking to hedgers or producers about?
Well, this report was about stocks, and it was about revisions in production estimates. And I think Virginia brought up a very good point, which is that price is a function of supply and demand. So these were supply reports. On the demand side, the big variable in the corn balance sheet is feed and residual. And there was nothing in this report that would suggest that feed and residual is going to be dramatically higher next year or dramatically lower. But there's been a lot of volatility around that, and we don't get a snapshot of what feed and residual is until the December stocks report, which will be released on January 10th or 12th. Mm-hmm. And that's the same day that annual production reports are released. So we still not quite sure what feed and residual is going to be. There's not going to be much change in ethanol grind. The other major variable in the balance sheet for corn is exports. And there's some evidence that USDA is currently underestimating exports of corn from both Brazil and Argentina. And unless they raise their estimate of global demand, any increase in their estimates of Brazilian corn exports or Argentine corn exports means lower U.S. exports. The same thing's true with regard to soybeans. Again, there is considerable evidence that they're underestimating the recent pace of exports of soybean sales out of Brazil and Argentina. And again, No one's anticipating a dramatic increase in soybean imports by China. And without China taking more beans, if Brazil and Argentina are exporting more, that means the U.S. will be exporting less. Lastly, U.S. wheat export sales are down sharply from what they were a year ago. The European Union, which is the world's second largest net wheat exporter, their export licenses are down 25% from what they were last year. And if you look at the pace of exports in the last 3 months out of Ukraine, Kazakhstan, and Russia, their pace of sales is down sharply from last year. That has some people wondering, is this just hand-to-mouth buying, that all the major wheat importers are simply buying it when they need it, or is global wheat import demand sharply lower than what USDA is estimating? I think we've only gone 2 to 3 months into the international marketing year. I think it's too early to press the alarm button on wheat, but clearly the pace of export activity out of all the major exporters isn't sufficient to meet the USDA's projection. Again, maybe it's hand-to-mouth buying, and they'll just keep buying throughout the year. But if it's not that, if imports are significantly lower, then that just adds to this huge burdensome ending stocks that we have. So clearly, once we get through the October crop report, the October yield estimates, any October adjustments of planted area, harvested area, I think the market's going to shift its entire focus to South American planting prospects and where's the export demand. And if South American planting prospects are higher than we're currently estimating, and if demand is lower than we're currently estimating, I just think that just piles more pressure on crop prices, wheat, corn, and soybeans.
Well, I think a really good summary of stocks and the supply side. Great addition on the demand side. Virginia, you had the first word. Any final thoughts before we sign off this afternoon?
Well, I just want to say that now that the futures for the last couple of months now are totally on the Globex platform, that you're seeing how volatility has changed somewhat, especially with the reports, coming right in midstream of the open outcry market, of the options, at least open outcry, right in the middle of the main market trade. We're seeing that the market gets overbought and oversold on each extreme, and it's happening with all the grains and with the meats, with the livestock as well. So I think that going forward, with all the fundamental information coming in when they're starting to price these models, that you're going to see a big wide range of volatility. And with volatility, that brings in trade, that brings in fund trading, and I think that a lot actually got involved, and a lot of funds got involved even trading with in the livestock market since it's been down so much. And I think that also is playing into the technical part of these prices, why they are the way they are. So if all the fundamentals start to fall into place, I mean, we might overshoot our objective on the downside as we have on the upside. So that's just something to watch out going forward as all the information is coming in, certainly for the next month.
Bill, you have the final word. I know we got a really good summary from you.
Well, like I said, the October crop report is coming up. I think it's going to narrow the range around what people are talking about in terms of yield. It'll also probably finish off any adjustments with regard to area. So after the October crop report, I think the North American, actually for that matter, the Northern Hemisphere supply is pretty well known. And once that gets put away, then you shift to Southern Hemisphere production prospects and demand. So we do have another opportunity, depending on how the reports come out, to see some pricing opportunities. But after that, unless it's demand or something happening in Southern Hemisphere weather, the game's not over yet. But clearly, we're in the last inning.
Well, that's a great way to end our panel discussion today. I want to thank both of our experts, Virginia McGathey and Dr. Bill Tierney. Thank you both for joining today. An archived version of today's panel will be on our YouTube channel. It is youtube.com/CME Group TV. Thank you very much.